I'm Bridget Stomberg.
And I'm Lisa D. Simone.
And this is Taxes for the Masses.
Today's episode is on state tax conformity.
Any state that imposes an income tax has the choice of whether and to what extent it wants its tax laws to follow federal tax laws. In today's episode, we discuss the basics of state tax conformity. Using OB3 as an example, we discuss the complexity that taxpayers can face when states choose not to fully conform with federal tax laws. Hello, Lisa.
Hello, B.
Today we're talking about state taxes.
Yes.
Which makes me want to ask you, when you were in practice, how much did you deal with state taxes?
A fair bit, actually.
Okay.
Because I was in the Kansas City office, which spans two states. Kansas City is both in Missouri and Kansas.
Yes, I did know this. Mm-hmm.
Yeah. So our state and local tax practice was very, very big there. And the transfer pricing group, like normally we think of a transfer pricing as an international thing, but it's cross-border transactions, and that includes states too. So they looped us in fairly regularly.
And did you like state tax work?
I did. I found it interesting. Like the trips were not as fun as the international trips, but yeah, I thought it was interesting.
Okay. I also did a lot of state tax work, but it was more around situations like we're talking about today, where you had to make adjustments because states were not conforming with taxable income, and how much of an ultimate ass ache that can be.
Yeah.
Yeah. Mm-hmm. So state taxes are a little triggering for me.
I'm very sorry that you're triggered,
That's
but
okay.
this episode was your freaking idea.
It was. I mean, it's fine.
Okay. Yeah, so we're diving into an issue today that sometimes gets overlooked when Congress passes a massive piece of legislation like they did over last summer, 2025, OB3. This issue is state tax conformity.
And listeners, while it may sound dry...
It does. Yes, it does.
It's because it is.
Yes, 100%.
Sorry. No, I'm not going to try to sugarcoat it.
Okay, good.
It's dry.
It's super dry.
But it's critical.
Okay.
It's like the dentist. Like, it's not fun, but you got to do it.
Okay.
Because it essentially determines how much a huge federal tax change, particularly a tax benefit, is actually going to affect your state income tax return.
Yes. And with state tax rates as high as 13% in California, state taxes matter.
They do.
Over the next 20 or so minutes, we're going to explain what conformity means and explore how OB3 is impacting state budgets and their policy choices around conformity. And we're going to try not to fall asleep or put you to sleep. We're going to try.
I think I'm going to do it.
Okay.
Because this was something that, like, I knew about a little bit, but I didn't know all of the details. So there's some stuff to be learned in this episode.
Okay.
Okay. So let's jump in.
All right. Let's start with the basics. Why do states care what the federal government does with the tax law?
So it's not a very sexy answer. It's mostly about administrative ease and efficiency.
Dry. We said this was dry.
We did. So most states use the Internal Revenue Code, or the IRC, which is the federal tax law, as the foundation or the starting point for their own individual and corporate income tax codes. And that makes sense because the closer that your state tax law is to the federal code, by having that high degree of conformity, states are able to reduce compliance burdens for taxpayers because then they essentially only have to follow one set of rules. So making your state tax more like federal tax is taxpayer friendly.
It's also state friendly.
It is.
It makes things easier for the state because their tax authority can rely heavily on federal statutes, rulings, interpretations, etc., even federal audits and taxpayer data.
Exactly. So if both returns are using the same starting point and the IRS comes in and makes an adjustment, like, you just get to report that adjustment down to the state, and the state auditor doesn't really have to do too much.
Sounds easy.
Okay. So that all sounds great, but even if a state uses the Internal Revenue Code as the starting point, it doesn't mean that they automatically adopt every change every time Congress makes one.
Okay.
States can utilize different types of what we call conformity, and there are two main approaches: rolling conformity and static conformity.
Okay. I'm starting to fall asleep just a little bit.
Just come on, let's go with it.
Rolling conformity is also called automatic conformity, and it means the state automatically aligns its tax code with the current version of the Internal Revenue Code. If Congress changes the federal tax law, states with rolling conformity incorporate the change automatically unless they pass a law to decouple or not follow that specific federal provision.
Okay. On the other hand is what we have static conformity or fixed date conformity. So states with static conformity match their tax law to the Internal Revenue Code as it existed on a specific date. An example would be California. So California generally conforms to the Internal Revenue Code as it existed on January 1st, 2015. Interesting date.
Interesting.
And this means that for federal changes enacted after that fixed date, like the Tax Cuts and Jobs Act or OB3, incorporation of those changes into California's law happens only if the state legislature manually votes to update their conformity date.
Okay, so it sounds like states with static conformity have a lot more control over which changes they adopt and when?
Yes, absolutely.
Okay.
You are following along. So regardless of whether a state uses static or rolling conformity, every single state modifies the Internal Revenue Code in some way. No state adopts the federal code outright. They might add or subtract provisions or specifically decouple from specific code sections.
Okay, well, this is great. I now understand what conformity is and what types of conformity there are.
Yes.
So now let's talk about the factors that lawmakers consider when deciding whether to conform to a federal change at all.
So there are two key considerations, and they are generally one, revenue impact.
Sure.
So how much is allowing this extra tax benefit going to affect my state level revenue?
Right.
And policy implications. Is this something that I am for or against at the state level?
Okay.
So, for example, there are some changes that if the state were to adopt them, they would reduce state tax collections and maybe offer very little economic benefit to the taxpayers of that state. Or maybe they would be offering poorly targeted relief to taxpayers of that state.
Okay.
On the other hand, some changes might represent pro-growth improvements to the tax code that lawmakers think are worth the cost, even though they're sacrificing tax revenue.
Okay, so it's like this great balancing act where you have to balance ease of administration against policy goals and tax revenues.
And that all sounds logical in theory, but practically, let's talk a little bit more about how federal and state taxes interact.
Okay, that's a good question. So most states use some measure of income from your tax return as a starting point in computing their taxable income. So they start with your federal tax return and then make some adjustments. About 30 states use adjusted gross income from your federal return. 5 states have their own special starting point that's essentially adjusted gross income. And about 5 states use federal taxable income as their starting point. Then states can legislate adjustments to that starting point to get their own version of taxable income. States that conform less to the current federal law are going to require more adjustments.
And in case anyone was curious,
okay,
Indiana is a static conformity state.
I think you're the only one who was curious.
And if we're quizzing anybody, the other name for static conformity is fixed date conformity.
Yes.
And Indiana conforms with the Internal Revenue Code as it was on January 1st, 2023.
All right. Did this satisfy your curiosity?
It did. You're welcome. All right, now that we've talked a little bit about the different types of state tax conformity and the balances, the trade-offs that state legislatures have to make when deciding how much to conform, let's turn our attention to OB3. We talked about on many episodes the multiple federal tax changes that OB3 brought forth, and in doing so is essentially forcing states to make some conformity decisions.
All right. Let's look at my favorite topic first, some of the personal income tax changes of OB3, which included several new temporary deductions that we've talked about previously.
That's right. So for individual taxpayers, OB3 introduced temporary deductions for qualified tips, overtime premium pay, and personal passenger vehicle loan interest. Now, all of these provisions are taxpayer friendly, which means they're reducing individuals' federal taxable income. So if a state decides to conform and also allow these deductions, it would cause a reduction in state taxable income and state tax collections, all else equal.
States are pretty much all over the place in terms of how they're responding. So, for example, according to the Tax Foundation, Colorado, which is a rolling conformity state, it's conforming to deductions for tips and auto interest, but not for overtime pay. Iowa is another rolling conformity state, and it's conforming to all 3 new deductions.
All right, so we've got 2 states that are both rolling conformity. One's adopting all 3. Colorado's only adopting 2 of the 3, so you might ask why. So just like we talked about, Colorado decided to decouple or not conform to the overtime deduction because if they had conformed, if they had adopted that new provision, it would have caused a huge revenue loss for the state. But they decided to allow the tip deduction because it actually provides relief to lower income taxpayers. So that was a case where they thought that the lost tax revenue was worth the policy goals.
Ah, okay.
So you can see that Colorado is a pretty good example of that balancing act between budget pressure and policy goals. You might come to different conclusions for very similarly positioned tax provisions.
Yeah. Okay, that makes sense. Many blue states with static conformity are passing altogether. New York is going to require taxpayers to add back any tip or overtime deduction they claimed on their federal return, and they're citing the need to protect over $1 billion in annual revenue behind their decision.
Wow.
California and Illinois are also not conforming, basically claiming that they can't afford the lost state tax revenue.
And that's fair because the estimated revenue effects of states complying or conforming with these provisions are substantial. So the Tax Foundation estimates that if all states with a personal income tax conformed to the no tax on tips provision of OB3, so just that one provision, it would cost $1.5 billion of tax revenue in 2026 alone.
Jeez.
No tax on overtime would cost upwards of $11 billion.
Holy shnikes.
Yeah.
That's a significant hit to state budgets, especially when you consider that these provisions are temporary.
Yes.
And they've been criticized for being poorly targeted.
Yes.
We see at least some states deciding that the policy juice just isn't worth the budget squeeze.
Okay, so let's shift to some business provisions of OB3. Unlike the temporary personal deductions that we just talked about, many of the restored and enhanced business deductions are considered to be pro-growth because they're lowering the after-tax cost of investments in property and research and development.
Yep, the big ones are restoration of full expensing for machinery and equipment, which was previously phased out, and the restoration of immediate expenses for research and development expenditures, reversing a change that had taken effect in 2022 that we discuss on a different episode. These expensing provisions generally reduce state tax revenues, but they have a strong economic justification.
Yeah, so this is a place where the lost revenue might be worth it from a policy perspective. The nationwide cost for all states conforming to these business expensing provisions is estimated to be about $21 billion a year, which to me sounds big.
Yeah.
But it's actually only 0.6% of total state tax revenues.
Oh, okay.
So relatively speaking, the cost is modest, and most states have the capacity to incorporate these provisions, and there's a lot of economists who are suggesting that they do incorporate them because they're considered to be pro-business, pro-growth provisions.
I would say that we should discuss the state tax conformity issues around the tweaks that OB3 made to the international provisions, particularly things like GILTI. But yeah, that's a pile of nonsense.
Could we get just like a teeny tiny TUNSYS high level 10,000 foot summary?
Oh, I will try.
Okay, you can do it.
OB3 rewrote the rules for how U.S. companies are taxed on their foreign income, replacing the old GILTI system with a new framework that some people are referring to as a necktie.
No.
Yes.
No.
NCTI.
No.
Yep.
No.
I've heard it.
And just no.
Okay.
A CAMT and a necktie?
Yep.
Okay, anyway.
It's not nearly as good of an acronym.
No.
GILTI, you at least understood what the intent was.
What we were going for.
Necktie? I don't know. The changes were designed to better target profit shifting to low tax countries while avoiding double taxation when companies pay significant taxes overseas. But when states comply, the results are a total freaking mess.
Okay, I'm excited to hear what you have to say
That is the proper technical term.
Okay.
It's a total freaking mess. First, states generally don't allow foreign tax credits even though they tax foreign income.
Really?
Yepers.
Okay.
Second, the new rules pull more foreign income into the state tax base, even though that income has little or no connection to activity in the state.
Well, yeah.
Yeah. In practice, this turns a federal anti-avoidance backstop into a state-level tax increase that undermines competitiveness and discourages investment.
So sort of the exact opposite of the intent of the federal provision?
Exactly. And a good reason for states to decouple from the federal international tax regime rather than adopting rules that were never designed with state taxation in mind and produce results directly at odds with their economic interests.
I think you did a very nice job of explaining that. It's just a bad idea.
It's just a bad idea. Okay, time for the good, the bad, and the ugly, starting with the good. I learned a lot about conformity, and so far I'm mostly awake. I mean, as awake as I am ever right now.
It's great. Yes, you time change. Been up since 4:30 in the morning.
Yeah.
Yeah. I agree, and I think that the idea of conformity itself is nice. We have over 40 jurisdictions in the U.S., state jurisdictions that tax either individuals or businesses, and so it's nice that you don't have to start from scratch and come up with your own bespoke tax code, that you can start with the federal law and then tweak it as you see fit.
Sure.
Maintaining up-to-date conformity has benefits for taxpayers and tax administrators that we talked about. It reduces compliance burdens, and it basically allows states to conserve some administrative and audit resources.
And some of the conforming, the tax law changes at the federal level were intended to help companies.
Yes.
They were intended to spur economic growth and investment, things like the full expensing of R&D again and other stuff. So, I think that's probably good that states are conforming there.
I agree. So administrative ease, good for taxpayers, good for the economy. What do we not like about conformity in general, or about OB3 conformity specifically?
Yeah, I'm going back to the variation that we talked about across states on what they were doing with these new temporary personal deductions, things like tip income and overtime and auto loan interest. And while I don't love all of those deductions, it just adds complexity if you get them at the federal level, but you don't get them at the state level. And that varies by state, too. It's very complex.
And it's sort of annoying to think that just as a result of where you choose to reside, you could get more or less total tax benefits than somebody who's in a very similar economic situation as you, but lives in a different state, right? It seems like it's ripe for violating horizontal equity principles. If I live in a state that fully conforms, you live in a state that doesn't conform, we both have the same job and make the same amount of money, we could wind up owing different taxes just because our states decided to do things differently.
You should move to a no income tax state like Texas.
I mean, I was told by some Republican that was the solution to all of our economic problems. Just move to a red state.
Okay, sure. Yeah, that makes sense.
Ugly.
Yeah, I mean, I can attest to this. So back when I worked in Kansas City doing some state and local taxes, I lived on the Kansas side and I worked on the Missouri side. It was a pain in the butt.
Yeah.
I have not used TurboTax since then because TurboTax was trying to take my income in Kansas and add it to my income in Missouri and was basically trying to double tax my income.
Okay.
Yeah, it was terrible. I'm sure it's fixed by now, but it was such a headache that I have not used software since then. I'd rather do it myself. And that's saying a lot because filing a tax return in 2 different states, total pain in the butt. Yeah, so the complexity for a taxpayer filing in multiple states, now when you have different conformity across different states, it's like, it's I don't even want to go there.
No, and you're 100% right. And I still have nightmares about bonus depreciation schedules for business taxpayers because some states fully conform, some states fully decoupled, and some states had some like hybrid in between where they were going to do their own bonus percentages. And so you would have to keep like 5, 6, 7 different depreciation schedules for a company. Like, it's a waste of time, especially for something like that, because it's a temporary book tax difference. It's all going to come out in the wash. It's all timing. Like, the amount of compliance costs that decoupling creates can be excessive.
Yeah.
And it's sort of like, to what end?
Yeah.
So complex for the taxpayer, and, I don't typically give a lot of love to politicians on the show, but it also makes the state legislature's job incredibly difficult because for every single time that they have to decide there's a new federal tax change, they have to weigh this cost and benefit, weigh the administrative ease with policy choices and revenue impacts, and decide on a case-by-case basis what they're going to adopt and what they're not going to. And we've talked about this a ton on the show. It's not that big of a deal when we're not constantly changing the federal tax law, but now that we're constantly changing the federal tax law, it's just making everything more complicated.
Yeah. I mean, the really ugly part of all of this, though, is the necktie acronym.
Absolutely, and I didn't know that, and I kind of wish you hadn't told me.
Gotta live with it.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.